haven't met me before or spoke to me, my name is Jeff Kavanagh. I work for MHA Tait Walker, and we look after and administer the BSM pension scheme. So I will just share my screen and bring up the presentation. Here today is an update on the BSM workplace pension scheme. So there's a couple of things that we're covering off. One is changes that have came into pensions in the last few years and how that affects you and your retirement. And secondly, also looking at a change we're making to the underlying investment within the BSM pension scheme and why we're doing that, and just a general update on how the pension scheme is doing, how it's performing. What I'll do is, I say, everybody remains on mute, and then if at the end or any questions, we'll use the chat function just to pick up any questions, and then as ever you can contact me directly or via the bsm@taitwalker.co.uk email inbox. Okay, I just think we've got a couple more people joining, so I'll just let them in. Okay, so what we'll cover off on this call, so an introduction to MHA Tait Walker Wealth Management, the company I work for, just as a refresher, and for those that haven't had a chance to meet with me or speak to me. Then just to look at the BSM's pension scheme, just a brief overview. Then just an update on pensions at retirement. So pensions have changed somewhat in terms of the flexibilities in how you access your pensions, and also what happens to any pension benefits when someone dies. So an overview of those changes. Then we'll look at where your premiums are currently being invested, and then the slight change we're going to make to that in terms of where future premiums will go going forward and why we're doing that. Then look at how the underlying investments performed, and also just we'll cover off earlier in the presentation the level of contributions, and then any questions that you may have at the end. As I say, we'll do that via the chat function. So key thing here, just a quick introduction to the company I work for. So key thing here is we are financial advisors, but we're independent financial advisors. Okay, so whenever we're giving any advice to any individuals or to BSM as an employer and a company, our advice is from the whole of the market, and we're totally independent, so we have no ties or bias to any one insurance company. So it's literally our advice is based on what is best for you and BSM. So I just thought it'd be useful because it's been some time since I've certainly met with some of you that have been in the scheme for a while, and I think for everybody it's just a good refresher as to who the scheme's with and why it's with them, why we've chosen them, and why we continue to recommend them. So the current workplace pension scheme is with Aviva, and it's jointly chosen by MHA Tait Walker and BSM. So some of the key reasons why we chose Aviva and why we continue to recommend them. So they've offered the best value within the UK pension market for a corporate scheme. Major pension provider, so your pension isn't with, say, a small boutique firm that no one's really heard of. It's a financially sound, large household name. Level of service and administration, so for people when they're looking to make changes or retire, their level of service is is exceeding what we'd expect and what we'd want to see. Key thing as well, they have a suitable range of funds to switch into. So whenever we need to make a switch for whatever reason to adapt or adjust the scheme, then we can do that within Aviva. We don't need to start looking elsewhere because we've got a good choice of available funds within that contract. Overall charging structure is very competitive. So the annual management charge, so the cost that's deducted from your pension by Aviva, Tait Walker don't receive any of that. This is just Aviva's cost for running the investments and having your pension with them, is 0.75% per annum, which is in line with the government cap on pension charges for auto enrolment for pension schemes. So it complies with that, and you've got access as I said before, to a financially sound household insurance name. So all of these things we continue to monitor and review, and we've recently again made our recommendation to BSM that we stick with Aviva and retain them for all those reasons. Level of pension contributions, I just thought quickly just provide a quick update and brief summary of the pension contributions. So this table on this slide just shows how pension contributions have phased in for the BSM scheme, and on that bottom line there, so from the 6th of April 2019 to where we are now and going forward, you've got the employer contribution from BSM is at 5%, and then employees under the automatic enrolment legislation putting in a total of 3%, which includes a tax relief from the government. So you have a total minimum contribution of 8% going in. Key thing to note just on the employer contribution of 5%, that's actually higher than what's required under the automatic enrolment legislation, but BSM said they'd want to put in slightly higher, and that means for those that just want the minimum going in, they have to put less in themselves. So BSM's putting it slightly higher. Key thing on here, I think, to note is these contributions, this is the maximum the government have announced for now in terms of contribution levels, but it could be in the next few years, next 5 years, we don't know, but we may see a further set of increases brought in to the contribution levels. Why we might see that is ultimately the government is looking to kind of have a cultural change in the UK to move more away from the state providing for retirement and more towards individuals and their employers funding their own retirement. So as I say, there's nothing announced yet, but based on where the contribution levels are at now and based on other parts of the world that have done similar things, you would expect to see that contributions would need to rise at some point in the future. And then when there are any changes, we will communicate that with you via your employer. So pensions at retirement, I just wanted to put in a couple of slides about pensions at retirement and also what happens to your benefits when you're no longer here, because there have been some significant changes and it does give you a lot more flexibility in terms of how you can access your pension benefits in retirement. So here, just two simple points here. So you've got two main options when you come to retirement in terms of how you draw your benefits down. Okay, now traditionally, until recently when the rules changed, most people would have gone down what's called the annuity route. So for an example, going down that route, if an individual got to retirement and they had a pension pot of say £100,000, there are options there with the annuity route. You can take 25% of your pension at retirement as a tax-free lump sum. That'll go into your bank account, you can pay the rest of the mortgage off, go on a holiday, all of the normal kind of at retirement things. Okay, so that 25,000, if it was a 100k pot, goes into your bank account. The remaining 75%, most people will be forced down the route of buying what's called an annuity. That's where you hand over your remaining £75,000 to an insurance company, and they will say to you, based on your age and sometimes based on your health factors, okay, how much they will pay you for the rest of your life every year for that £75,000 you're giving them. Now, some people felt that annuities were quite restrictive in terms of you were being dictated to by an insurance company how much you could have from the lump sum that you had saved up during your working life. Also, a lot of stories of where perhaps someone had saved into pension all their working life, they had handed over a large lump sum to an insurance provider, and then they had died early in retirement, and they'd only received perhaps a few years worth of payments, and therefore the insurance company would profit on the rest of it. Conversely, some people would live an awful long time and receive a lot of income from them, but people lobbied for a long time to remove the requirement to go down that route because of how restrictive it was. So 2015, big changes came in terms of how you access your pension, and there was something brought in called Flexi Access Drawdown. Okay, so the annuity route is still available, but Flexi Access Drawdown, what that means, if we take the £100,000 example again, so you get to retirement, you could take your 25% tax-free cash. You don't need to take it all in one go though. Okay, you remain at 75%. So in this example, 75,000, you draw down as and when you want it. Now it's taxable for income tax purposes, but you're not forced to lock into an annuity. So it's given people a lot more flexibility during retirement. So for a lot of people, they might want to retire slightly earlier than when their state pension kicks in. And that's given them the benefit to be able to draw down slightly more earlier on in retirement. And then when their state pension kicks in, they can kind of drop those withdrawals back a bit, as they'll not need so much to supplement their expenditure. So it has given people a lot more flexibility for those that want to kind of be more active in retirement earlier on. It does bring with it a range of challenges though, sustainability being a key one, in that judging how much you can draw and when, and making sure that's sustainable, that's a key thing, and that's where you need to seek advice in retirement or pre-retirement to ensure your plans are affordable. Because the last thing you want people doing is drawing out too much earlier on, and then perhaps they get into 75 and realizing they've spent too much too soon and they don't have enough to live on. So a lot more flexibility, but the need to be careful, seek advice, and be prudent with the amount you're withdrawing in retirement. So the key thing with the flexible access route is, rather than just locking in your money like the annuity route and locking it all into cash, handing it over elsewhere, whilst you're drawing down on it through retirement, it remains invested. So what you've got in your pot remains invested. It doesn't just lock in at 65 like you do with an annuity route. So your funds are invested for the longer term to try and grow them, and try and kind of extend the sustainability of that pot. I'll come on to how that links through to this change we're making to the underlying investment for the scheme. So also, when these additional flexibilities were brought in by the government to pensions, there was also changes to what happens to my pension on death. So the big thing again is people felt, hang on, I've paid into this pension all my life. If something happens to me, I want to make sure my beneficiaries can benefit from it, and that wealth can be passed on. So the government brought in massive changes and made them a lot more flexible in terms of individuals' benefits when they're no longer here. So for anybody who passes away before age 75, their pension pot is paid out to their beneficiaries tax-free, okay? Completely free of tax, and can be passed on all the way up until 75. And then post 75, if somebody passes away post 75, whatever is left in their pension at that point, provided they didn't go down the annuity route, whatever is left in their pension can still be passed on, but your beneficiaries will be taxed on what they draw from that pot at their highest marginal rate for income tax. So what your beneficiaries can do is they can draw it out over a number of years to spread the tax, rather than drawing out a large lump sum in one go. So that has massively changed people's options and beneficiaries' options. It used to be that pensions could only be passed on to a certain point, and thereafter they were heavily taxed to the point of it wasn't worth almost passing on anything because of the detrimental tax impact of it. So overall, pre and post retirement, a lot more flexibility with your pensions. So what we'll look at now is called pension lifestyling, and this is linked to where your premiums are invested when they go into your pension. So at the moment, when your contributions are going into your pension, they're invested into a lifestyle fund, and that lifestyle fund, when you're further away from retirement, that's investing you in funds trying to get you some growth to build up your pot over the longer term and get that growth that's beating inflation. Make sure your money's at least kind of retaining that purchasing power and growing your pot for retirement. So then when an individual gets to 10 years before retirement, the lifestyling process starts to de-risk them. Now, this is a key point as well. Currently on the BSM scheme, your state pension ages, the majority of people have chosen a standard 65, and that's perfectly fine, and that's where most people would have traditionally set their pension age. So the lifestyling is targeting age 65. So once you get to 55, it starts to de-risk your pot. State pension, that's increasing. So by next month, those retiring, it's up to 66 for everybody retiring, and then by April 2028, it will have increased to 67. Now, for those that want their pension benefits to be kind of managed in line with the state pension age, then it's worth dropping us an email at the bsm.taitwalker.co.uk address to allow us to increase it. So if you know you're not going to retire at 65, if you think, actually, I know already I'm going to be at 66, 67, 68, then let us know and we can change it. And what that will mean is the lifestyling won't kick in until later on. Okay, but you have got a lot of flexibility with that. So it's not like you have to take your benefits at 65 if it's currently 65, but it's just that's where the lifestyling will start that kind of phase down period too. So the current lifestyle strategy that we use is targeting an annuity purchase. So that's targeting it's still available, as I said before, but the traditional route where people in the past have locked in and bought an annuity. So there's various stages to that in terms of where it starts to phase you down. So when you're more than 10 years away from retirement, you're in the Aviva Pensions Mixed Investment Fund. And that's where currently the majority of you are invested. Okay. Then when you get to the 10 years from retirement, it starts to phase you down into more cautious investments till you get to 5 years to retirement, and then you get into really cautious investments, and then some 25% goes into a cash fund. Now, the reason it goes down and de-risks so much into very low risk funds and into cash within the last 5 years is because it's with an annuity, you've kind of got that one bite of the cherry, as it were, because you're locking in on your 65th birthday, you're buying an annuity. Okay, now it's fine if you're invested in this, you don't have to buy an annuity, but what this is doing, it's de-risking you as if you were buying an annuity. Whereas actually, if you want to take advantage of the new flexible rules at retirement, then you probably want some of your pension to still be invested with some opportunity for growth, because your pension may still be needed in 20, 25 years time. So you'll still be invested for the longer term. Whereas the annuity, you're locking in and handing your pot of money over to an insurance company. So we're recommending a new lifestyle strategy which targets flexible drawdown. So there aren't any changes in the first 2 phases. So for those that are more than 10 years away from retirement, you're still in the same investment fund. You phase down at the start at 10 years to retirement in the same fund. But the change comes when you get to 5 years to retirement. So rather than 75% going into a very cautious gilt fund, 75% goes into still cautious, but a fund that's still got some equity content in it, can still grow your money for more the longer term as well. And then you've still got 25% going into cash just to take some of the risk off there as well. But this approach is more suitable if you think you're going to go down the drawdown route, as it were, rather than targeting the annuity purchase where you lock in. From what we're seeing across the industry, the majority of people are going down the flexible route rather than locking into annuity. This is why we're making the change here to slightly change to a different lifestyling process. So for the majority of people, this would then target what they're actually going to do with their pension money in retirement. Key thing to note, just as you can see in red there, if you're already 5 years or less to your chosen retirement age, so in essence, in this scheme, the majority of people are targeting 65. So anyone in this scheme that's over 60, you can't now switch into this scheme because you've already started that de-risking process. However, it's worth noting what we can do for those that are already at 60, should already be having discussions and looking at your retirement options, and it then becomes something you may need something more bespoke in terms of a retirement plan. Now, if you're not already speaking to a financial advisor elsewhere, we can help you with that. And certainly if you are within that 5 years to age 65 period, then it would be worth contacting me and having an initial discussion just to chat through whether you're in the right place or you need to make some changes that are aligned specifically to your personal and individual plans and circumstances. But for the majority of people, it will be a case of switching over to the new lifestyle. You don't have to, but that's our advice, and that's what we'll be reviewing on an ongoing basis. So I've just put in some performance figures of the underlying investments. So for everybody that's 10 years away from retirement or more, and the majority of this scheme are currently invested in the Aviva Mixed Investments 40 to 85 fund. And then I've just put in the benchmark for this sector. So as we can see, it's slightly underperformed the benchmark for the sector, just slightly over 5 years, 0.2% under the benchmark over 5 years. Now that's partly down to COVID-19 and the economic impact that's had on global markets, but we're still comfortable that this is the best fund to be in. It still achieved excellent growth over 5 years, despite the short-term impact of COVID-19. And if you can just see on this graph, the blue line is the investment fund we're in, and from September 16, it's consistently outperformed the benchmark. It's only when we've got to March this year that it's kind of, for a time, started to just drop below and then above. But broadly speaking, it's tracking the benchmark at this point. So our investment committee and team reiterate that they're still more than happy to recommend this fund, and we continue to track it. And if any changes were needed, we would be contacting you proactively to say we need to switch out of this fund. So for those that are more than 5 years away from retirement, we'll be writing to you to set out, just in a short letter, what we've covered off here, why we're doing it, and there'll be an instruction form to sign and return to Tait Walker. We're actually going to do this via post. So if you haven't, well, if you've recently moved address and you haven't let Stacey know, please could you update Stacey with your latest address details so we can ensure the letter's going to the right address. Key thing in the middle of that, you do not have to switch. So Bird & Shorty or Tait Walker or Aviva, no one's benefiting from this by switching. It's purely the individuals that will benefit by targeting a more relevant retirement options. But you can stay in the old lifestyle process, which will just phase down and become slightly more cautious as you approach retirement, but more suitable for an annuity purchase. The majority of people that say are in this. For anyone that's not, we'll contact them individually to discuss their options. As I say, you'll get a letter in the next few weeks. If you're happy to go with the recommendation to switch into the new investment option, then sign the letter where indicated and just return in the prepaid envelope. So on that, I appreciate I've gone through quite a bit there. I'll stop sharing my screen in a minute, and then if anybody's got any questions at this stage, please feel free to put them into the chat box, and then I'll try and answer them based on how many we've got. And then also I appreciate, with it being financial planning, people don't necessarily want to chat about their individual circumstances on a Teams call. So feel free to email bsm@taitwalker.co.uk. So I'll just stop sharing my screen now. Okay. Okay, so I'll just leave it a couple of moments, see if we get any questions in the chat box. Okay, there's none as yet. Okay, well, I think we'll leave it there. As I say, any questions, please just email bsm@taitwalker.co.uk. If when you get your letter, if you've got any queries on that, please just drop us an email and we can pick those up with you. And as ever, any queries on anything, if you're at or approaching retirement and you want to better understand your options and how those relate to your personal circumstances, then again, just contact us and we can arrange an individual meeting. Okay, so we'll stop the call there. So thanks very much for coming on, and thanks for your time.
Thanks.
Thank you very much.
Yeah.
Thank you.
Thanks.
Cheers. Thank you.
Thank you.